Hey everybody, welcome to Mortgage Today for Tuesday, May 18th. For Tuesday, May 28th, 2024, and oh, what a day it was. We were off yesterday, Memorial Day. Hopefully you made some time to thank a hero for the freedom that we have. Back to work on Tuesday, UMBS opened up. Back to work on Tuesday, UMBS opened up 5 basis points to start the week. S&P Futures were up 5.5 points. We got the FHFA home price index, which was up 0.1% on the month versus a 0.5 estimate. It was 1.2 previously. Case-Shiller home prices were up 1.6% versus 0.9 previously. Consumer confidence was up 102 versus a 95.9 forecast. It was 97 previously. The upcoming week will have some important data with home prices, the second revision of Q1 GDP, and personal income outlays on Friday. The personal income outlays report contains the PCE Price Index, which is the Fed's favored measure of inflation. The consensus estimate is for headline PCE to be 0.3% month over month and 2.7% year over year, while the estimate for the core rate is 0.2% and 2.7% year over year. Fed fund futures see no chance of a rate cut at the upcoming June Fed meeting and even have a small chance of a hike. The December futures see one rate cut this year as the most likely outcome. The Fed released the Economic Well-Being of America study. In 2023, the economic well-being of most Americans slipped slightly from 2022 and well below 2021, where the government was shooting a bazooka money at everyone. The one exception was parents of children under 18, where well-being fell 5%. 63% of all respondents said they could cover an unexpected $400 expense, which was down from 2021. The government stimulus in 2021 created excess savings, and it looks like that savings has been largely spent. This might explain some of the tepid results we are seeing in consumer spending and the vexing for Democrats, at least five session where the official numbers are good, but the mood of the consumer is not, because it's all going on credit cards, and they know it. The 5-year Treasury auction today came in at 4.553 versus 4.540 expectations. Bid to cover was 2.30x versus 2.40x average. These aren't the worst auction results we've seen, but they're on the wrong side of neutral if we're hoping to see bonds push back towards stronger levels. Bonds began the day modestly stronger, and that was the first mistake. Starting around 10 a.m., the gains began evaporating following comments by Fed's Kashkari, who needs to see many more months of good inflation before considering a cut, and a big pop in consumer confidence data in the next 3 hours. In the next 3 hours, both the 2-year and 5-year Treasury auction would add pressure. UMBS were only down 1/4 point on the day, which was an unremarkable move for the first day back of a 3-day weekend. But in contrast to the low volatility gains of the first 2 hours a day, it feels subjectively abrupt. Mortgage lenders concurred based on the number of reprices and second reprices that happened. UMBS closed the day down 36 basis points at 99.81. It's never fun having that number be under 100 at 99.81. That is putting us just right above this Fibonacci line at 99.647, which if we look at how hard it was to break above that for about 2 weeks there, we don't want to dip back underneath there. And then, man, this 25-day moving average has been all over the place. That has converged upon the 200-day moving average. It is our new ceiling. We also got news. The Mortgage Bankers Association last week released its quarterly IMB profitability study. The good, lenders only lost $645 per loan. So we're losing $645 per loan last quarter. The bad, lenders lost $645 per loan last quarter. Sterling Point Advisors' Brett Ludden went a bit deeper into the study to elaborate on what these mean. First of all, some lenders perform better than others. Small originators continue to really struggle in Q1. The graph that was in the article shows production buckets from Q1. Lenders who did less than $200 billion annualized lost almost 70 basis points in the first quarter. Lenders in the $400 million to $1 billion actually eked out a small profit, but the larger lenders were not so lucky.